Good morning, everybody. Actually, for some of you, good afternoon. Um, Thank you for joining us for today's training. Today, we got a very interesting one. We all work really hard to get those deals, right? And then we want to make sure that we don't lose the deal because of mismanagement of the loan file. And one of the areas that can really come back and bite us is the rate lock, right? The rate lock, lack of the rate lock, maybe locked it too soon. I mean, a couple of bunch of different uh, issues that can occur with the interest rate that can blow the deal, right? So, like I said, we work really hard developing the lead, um, uh, working to get the loan into a loan application, disclosing the file, submitting the file, and the last thing we want is for the loan to fall apart because um, of the rate lock or the interest rate. So I'm not going to jump ahead because there's some interesting stuff to go over here. And like I said, this is very important. Some things here that you may not have realized that can occur because of a rate lock or lack of a rate lock. And that's why you're all here today to make sure that you don't fall into these pitfalls here. So let's get right into managing interest rate, excuse me, mastering interest rate lock management. So, what exactly is a rate lock, right? A rate lock or an interest rate lock is an agreement between a borrower and lender that allows the borrower to lock in the interest rate on a mortgage for a specified time period at the prevailing market rate or the rate chosen, basically, and provides the borrower with protection against a rise in interest rates during the lock period, right? Now, one thing I want you to be aware of, really important here, we're going to cover this a little bit more in depth in the following slides, but a rate lock also, and this is what most people are not aware of, but is probably as important or more important in these volatile times. A rate lock also locks in the guidelines for that program. And why do I say that is important in these volatile times? Because when we have a lot of volatility in the rates, we have volatility in the industry, and we may tend to have adjustments to the risk factor for the packages or for the proposed packages that may be coming down the line for that investor who's buying these mortgage backed securities, right? So they may decide that they want to reduce the risk on the mortgage backed securities that they're buying, on the loans that are collateralizing these mortgage backed securities. So they may decide to change the guidelines, right? That's what the guidelines are. The guidelines are basically um, the the um, the requirements for the purchaser of that package to those are the conditions under which they will buy the paper. Let's just put it that way. And if they foresee that this increase in volatility is going to increase their risk, how do they reduce the risk? Well, one way to reduce the risk is to increase the rate. That doesn't really reduce the risk, but it increases the profit that you're going to make on that risk. But the way to really reduce the risk is to tighten up the guidelines, right? And that's what you got to be aware of. A rate lock will not only lock in the rate, but it will lock in the guidelines. So just imagine your borrower has a 620 score and he barely, squeaked into those guidelines, and now all of a sudden you haven't locked it in, and they change the guideline and they say now it's a 600 score minimum for that product, and you didn't lock it in. Guess what? Now you no longer have a loan. So we're gonna I'm sort of jumping ahead a little bit here, but I just wanted you to make you aware of rate locks. Lock in the rate and lock in the guidelines. Interest rate risk is the risk that market interest rates will rise, which will cause a decline in the value of the instrument, the loan package. So that's another reason why secondary is always looking to hedge their risk. Pull through rate. That's very important for us as lenders. Pull through rate is the number of loan applications that are closed and funded by the lender versus the total number of submitted loan applications over a set period of time, right? We want to make sure that we fund what we submit and that we also fund what we lock. And this is also very important in these volatile times is float down. Now be aware, not every investor and not every lender out there allows a float down, just to make you aware. But a float down is a policy that allows renegotiating the lock once a minimum threshold difference has been reached. Now, what do I mean by that? Okay, what I mean by that is that in order, so the investor could have a policy where they may state, okay, if the pricing on that loan at that rate decreases by at least 1 point in cost, then we would allow you to request a float down, as an example, which means, okay, we have 7.75 locked in at the cost of 2 points. We've been watching the market and now it's a little bit cheaper. And now the cost for that rate is 0.75, right? That's a 1.25 point difference. So then we can reach out to the lock desk and we can ask for a float down and they will confirm the pricing is different. And then they will let us float down, but do be aware that there is a price to that float down, right? There's typically a price, and in most cases, it's half a point. And hold on 1 second here a minute, folks. Sorry about that. So that's very important to note that when we are able to float down, there will be a cost to the float down, and it can be whatever that investor says, but usually I find it to be around a half a point. So you're not going to get the full benefit of the reduction in the cost, but there will be some benefit, and they do that so that the files basically aren't canceled out of there and submitted somewhere else because the customer says, hey, the rates went down. There's no way I'm going to close at that rate now. If you don't find a way to get me a lower rate, I'm going to cancel the file and go somewhere else. So that's when we reach out to our lock desks. I see what the scenario is and try to do a float down. So do be aware float down possibilities exist. It's not across the board possible at every investor and every lender out there. Just do be aware how it works. So we've given the training before on what actually affects interest rates so that you as a loan officer can be proactive and give some good advice to your borrower as to locking in, not locking in. But you should always have that conversation with your borrower. I always recommend that it also be put in writing, because if you email the borrower and tell them, hey, today's a good day to lock, 10-year treasury is down, and in yield, the rates, the cost on the rate has dipped a little bit. Let's lock it in today. And if the borrower replies, hey, no, I don't want to lock it in today, I want to wait, then you want to make sure that that's you have that in writing from the borrower on the email so that there's no issues later. If there's a spike in the rates, for the borrower to be calling you out as to why didn't you lock my rate in, right? So definitely understanding interest rate fluctuations is key, right? Now, what exactly is interest? Interest is a price that you pay to borrow money. and is typically expressed as an annual percentage, right? That's everybody knows that, the cost of the money. Now, this is a condensed version of our training for what, interest rate fluctuations, but factors that affect interest rates are the Federal Reserve, right? Like we know the Federal Reserve gave some comments yesterday talking about, inflation is not yet out of the horizon and we're not going to lower anything. They weren't going to lower the uh, the Fed funds rate. So, there was some volatility yesterday. The 10-year dipped a little bit yesterday. It dipped a little bit more today. So obviously, what the Federal Reserve does through their open market operations, sets interest rates, manages the money supply, right? When they were buying the bonds that were being issued by the Treasury, they were monetizing, as they were calling it, and they were increasing the money supply. They were basically, Treasury was printing bonds, and the Fed was buying the bonds. So they were monetizing, messing with the money supply. Uh, Fed also regulates financial markets and acts as a lender of last resort during periods of economic crisis, as we saw during the pandemic. So Federal Reserve is a big part of what happens. So you should all understand some of the factors, right? So, for example, they were talking yesterday about inflation. When we do have inflation in the horizon, the Federal Reserve counters inflationary pressures by raising the Fed funds rate, which increases all other borrower costs down the line, right? Um, Fed funds rate is the rate that banks charge each other for overnight lending. So banks have to have meet a minimum capital reserve requirement. I can't recall what it is right now. When I took that class, Finance 351, I think they called it. It was 2% was the capital reserve requirement. They had to have 2% on in liquid funds to back all of their liabilities. So how do they meet their requirement? They borrow overnight from banks that do have the liquidity that buy, and that's called Fed funds. So when you increase the interest rate on Fed funds, it increases banks' cost to operate, and then they simply are going to pass that cost on to the consumer in all the different operations that they do. So you can see how the Federal Reserve increasing the Fed funds rate increases the rates as well. Unemployment rate, depending on which way the unemployment rate is going, is what the Federal Reserve is going to do with Fed funds. So if the unemployment rate is lower, that means we have a hotter economy, more spending, higher prices. So what's going to happen then? The Fed is going to increase the Fed funds rate to slow down the economy. Actually, increasing the unemployment rate at that point is the goal, believe it or not, right? So things aren't always what they seem to be. Sometimes you can be doing too good, and then you get an overheated economy, and that's where you can get inflation that can get out of control. Now, there's other factors that come into play there regarding the money supply and everything else, but the Fed is a little limited in what they can do. So one of the ways they're directly going to do it is, again, Fed funds rate. If the unemployment rate is higher, then they'll reduce the Fed funds rate to spur the economy into activity. They're always trying to find a happy medium there. And gross domestic product, GDP, right? That's another thing that the Fed looks at. GDP determines and one of the things you should look at too, GDP determines our, as a country, ability to pay and also our need to borrow. If the GDP is high, we're going to count the assumption is that the economy is making money. We shouldn't need to be borrowing that much money through bonds. But if the GDP is low, the difference is usually made up with borrowing, right? So if we borrow more, the rate of the instrument will need to increase. So all of a sudden we need to borrow more money and they need to put a bunch of bonds out into circulation and they want them to be bought. They're going to have to increase the yield on those bonds, which is the same as increasing the interest rate on the bonds, which eventually trickles down to affecting interest rates on the loan. So, again, the training that we have on this goes a lot more into it, but this gives you an idea as to what's happening, why what happened yesterday happened, and why what's happening today. That's why today's probably a good day to lock. So, let's talk about some of the challenges. Now, I already mentioned it in the beginning, but market and interest rate volatility is a definite challenge, right? Because if the interest rate spikes, the borrower may no longer qualify at that higher rate, right? If you're doing if your DTI is at 49 at 7.75, and the rate is now 8.5, your DTI is going to be above 50, and if that was the threshold for your program, then your borrower no longer qualifies. The same if it's a DSCR loan. Your DSCR is a 1.00000001, right, at that rate. Now all of a sudden you increase the rate. Now your DSCR is under 1. Your borrower now may no longer qualify for that 80 or 85% LTV program that required definitely a 1 or above DSCR. So now what do? Right? So again, without knowing specifics of the loan, can't really tell you what to do, but you're definitely going to have to do some restructuring. Now, bullet point number 2 is the one most people don't realize that I was talking about: revision of the guidelines, right? Guidelines tightening to reduce interest risk. Now that disqualifies a borrower because the borrower wanted to wait, they didn't lock it in, or for whatever reason it wasn't locked in. When the loan was disclosed, the disclosures were signed, and the loan was registered. That's as the soonest that we can get a rate locked. The file has to exist in the portal of the investor. It has to be already registered as a loan in the portal of the investor who's going to buy that loan. And then that's the soonest that you could request your rate lock. So as soon as disclosures are signed, intake grabs a file, completes intake, registers a loan on the portal of the investor, that loan can be locked. Obviously, they're also going to submit it to underwriting at that point, but that's the soonest that the loan could be locked. And in many cases, we recommend that's when you should lock it in. Why risk interest rate volatility with a file if the customer signs the disclosures at 7.75%? They're going to think in their mind, remember, they're not loan officers, they're a borrower, they're the consumer. They may think in their mind that's the rate they're going to get. If you guys haven't discussed rate lock yet, hopefully you have discussed rate lock. You have explained to them the loan is floating. But even if you do give them all that explanation, in their mind, that's still the rate that they're happy with. Let's put it that way. And if all of a sudden, 3 weeks later, the rates are 0.75% higher, and the borrower asks you, well, why didn't you lock it in? And you don't have an answer for them that makes sense, they're going to be looking at you to make up the difference, or they may just get upset. And if it's not an urgent situation that they have the time to go somewhere else, they may just cancel the file on you and go somewhere else to handle their transaction. So again, bullet point number 2, revision of guidelines, very important factor of having the rate locked. That's why you should really try to lock it in as soon in the process as possible. And when you do lock it in, if it's a purchase, unless you have an appraisal waiver, I would not recommend doing a 30-day lock. I would probably recommend doing a 45-day lock just to make sure, because if for whatever reason now you need to extend the rate lock, it costs 2, 3, 4 times more to extend it than it would to get the 45-day versus the 30-day if you're looking to get a 15-day extension. Usually the difference between a 30-day and a 45-day in cost is 0.125. That's 12 and a half basis points. Excuse me. So in cost, not 0.125 in rate, but 12 and a half basis points in cost, 0.125 of a point. I mentioned elimination of programs. That goes hand in hand with revision of the guidelines. So in some cases, the whole program is eliminated. Now, we saw that with the pandemic, for example, in non-QM, where a lot of programs were eliminated because there was no funding for them. So if If you had it locked in, maybe they would have closed you, but that was extenuating circumstances where secondary just shut down and was not buying those types of programs at all. So there's no guarantee there, even that if you were locked in, they would have closed that loan for you or funded it for you. Let's put it that way, or bought the loan. Actually, is what we're talking about. So we mentioned higher cost, right? Borrower no longer qualifies due to funds shortage caused by the higher rate. So what do we mean by that is, well, now we may have a higher loan to value, excuse me, lower loan to value, which requires a higher down payment. That's what I meant to say. So now maybe we're at 25% down payment instead of 20%. Borrower doesn't have the extra 5% down. Or maybe instead of being a par rate, now it's costing 2 points, two and a quarter, two and a half to get that same rate. Borrower may not have the funds to cover that either. And you know they're going to be coming looking at you, asking you to contribute to this shortage if they feel that you're at fault for not having locked in their rate and not having had that discussion with them. So the risk here is that the borrower not be able to close if they do not have the additional resources. So you notice in the end result in any of these four bullet points is you're going to get a borrower that's becomes upset, could cancel the loan, and obviously if they do cancel a loan, vow never to conduct business nor refer a loan to the MLO nor to the company, because they're going to hold you and the company totally at fault for what's happened. So you definitely want to manage the situation properly, be proactive so that you don't have any of these situations that can very easily occur. I mean, I just had somebody the other day on a file and I asked them, why haven't you locked in this rate yet? And they're like, well, we're waiting for the appraisal. I'm like, well, you're waiting for the appraisal? You don't need to wait for the appraisal. Oh, well, I just wanted to make sure that the income was good because I thought that maybe if the income comes in a little higher, the debt service coverage ratio will be better and I'm going to get a better rate. Well, guess what? When you lock in the rate, you're locking in the pricing of that day. Should the income come in higher and the debt service coverage ratio is higher, then you just request a profile change that the DSCR is higher, and then whatever applicable pricing adjustment will be made. Because conversely, if the DSCR comes in lower, you're also going to have to do a profile change, which is going to reduce the DSCR on the loan file, and it's probably going to result in a higher cost to the rate, or in some cases, possibly having to go to a lower loan to value. So again, no need to wait for anything to lock in a loan. The only thing you have to wait for is two things. A, the file has to be registered on the portal of the investor or lender. If we're the lender on the loan, which we are on most of these, it's the investor that's buying the loan. If it's a wholesale file, it's the lender who we submitted the loan to. But in all cases, the loan just has to exist on the portal of the investor or the lender to be able to lock it. So at that point, the only other deciding factor that's going to determine unlocking the loan is you have being proactive and having that discussion with the borrower as to locking in the loan. And that discussion should be made in the very beginning. In other words, you've already finalized the file, you've discussed it with the borrower, let them know disclosures are going to go out. You've sent it to our disclosure department to get the disclosures out. That's the moment that you should be having that discussion about the rate lock with the customer, to finding out, hey, as soon as you sign and I sign and the file gets uploaded to the investor's portal, we can lock the loan. Do you want to lock it already? This is the pricing that we have today. I can't guarantee you that 2 weeks from now the pricing is going to be there. So if you want to guarantee this pricing, we have to lock it in. And since this is a purchase, I recommend that we lock it in for 45 days instead of 30 days. That discussion should be had at that moment. And the customer should be the one to say yes or no. And if they say no, have them understand why, what are the potential pitfalls of not locking it in. Because if they think that rates are going to go down in the next week or two, okay, make sure that they put that in an email to you stating why they don't want to lock it in now, and then just keep following up with them on a daily basis, watching the 10-year treasury and following the economic indicators, and then reaching out to your borrower if you see that there's going to be a spike and letting them know, hey, listen, this just happened. This is going to affect pricing. Do you want to lock it in? You know, most customers, if you bring it up about locking it in as soon as a file is registered, they're going to want to lock it in. Normally, I don't know why some loan officers would not want to lock it in the beginning, but most borrowers will. But I've had some that have actually, some that follow the market that have told me, no, I think it's going to go down, it's going to get better, whatever it may be, and you know, they're the ones taking the chance on that. But you see what the end result can be is a very upset borrower and a lost loan and time and effort. So, what strategies are we looking at, right? I mean, we've covered all of these already, but let's, putting them down in bullet points, right? Analyze market trends and economic indicators daily and share these with the borrower, right? Early in the process, before loan disclosure, communicate to the borrower the need to lock the rate and confirm when the borrower, desires to lock the rate. Now, I just mentioned this one right now, right? Give yourself a cushion if not locking in right after loan disclosure, if locking in right after loan disclosure, and lock in for 45 days and not 30 days, as the cost to extend the rate is 2 to 3 times higher than the cost of the original lock if you were to go for 45 days instead of 30. Make sure that you properly analyze their credit, their income, and the property type prior to requesting the rate lock to protect the pull through rate. I mean, that's basically probably the most important thing here is just make sure your file is set up right and that everything is done right, because the last thing you want is for the file to go to underwriting and underwriting to come back to you with a totally different income, right? Or with the fact that, hey, this is you know a, a 2 unit property, not a 1 unit with an ADU, and it's a different rate, or whatever could cause the cost on the rate to change, because then obviously we got to cancel that rate lock in the file. That's going to affect our pull through rate, and if that happens enough time, our cost at that investor on our rate is going to increase, right? The lower pull through rate is going to result in not as good pricing for us at that investor. And very important, this is the last bullet point, but it's not the least important. Make sure to manage the borrower expectations throughout the process, right? What do I mean by that? Well, all of these things that we've been talking about, you want to explain them properly to the customer, over the phone, via email. Always want to follow up with an email of whatever you may have spoken with somebody over the phone to document all of these important processes and important steps of the process, to make sure that there's no misunderstanding later. And, oh, I thought you said this. Well, no, here it is in the email that I sent you as a follow up to our conversations. If you manage their expectations for whatever they may be, whether it be the rate lock or the day that they can actually close based on the loan type and the borrower type and all that stuff, you're going to have a positive and successful closing. But if the expectations aren't properly managed, you could end up with a borrower thinking that, for example, that they can float down whenever, that a rate lock is just to their benefit if it goes up, but if it goes down, they can just go down at their whim's desire, or that they can think that they can close the loan as soon as you get the clear to close, which isn't possible either, right? Clear to close just to clear to close, and then it has to go to the closing department, and that could be 1 to 2 days later. So there's a lot of expectations that need to be managed throughout the process to make sure that we don't have an unhappy borrower at the end. And the benefits of effective rate lock management are pretty obvious, right? Minimize interest rate risk, provide the borrower with certainty in their financial planning, right? They know how much they're going to need for the closing and how much money they have to have available. Increasing the borrower profitability by enhancing the financial stability of the deal, right? The proper financial planning allows them to make other maneuvers that they may need to make that allows them to stay liquid and, again, has a positive effect on their financial condition as opposed to a negative effect by this unannounced all of a sudden need to pull 10 or 20 or $30,000 out of somewhere that they really weren't able to do it just to be able to close on this deal, right? And it's going to increase uh, a positive overall MLO experience due to higher earnings by the MLO. So you as an MLO are just going to have a more, overall better experience with positive rate lock management because you're going to have higher earnings due to less deals falling apart from rate lock issues. You're going to have a higher earnings due to increased referrals from satisfied customers. You're going to spend more time on production and closings and less time dealing with borrower issues and complaints. And you're going to have a more positive overall business outlook from the increased satisfaction that you're going to be feeling of being a successful loan consultant, right? If you're not feeling it in your heart and in your mind, it's going to be very difficult for you to convey it to your borrowers, right? You got to have a positive experience about what you're doing. You want to emanate positivity. Borrowers feel that. They can definitely feel when you're charged up on a positive note, and they can definitely feel it when you're not. And the end result, the law of attraction, positive is attracted to positive, negative is attracted to negative. So you always want to be on that positive note. So that concludes the slides. So let me see if we have any questions here. Okay, in the chat, I don't see any questions. I see a question that I covered on, isn't it up to the customer to lock in the rate? No, it's up to the customer to communicate that they want it locked, but it's really up to us to ask the borrower when they want it locked in, because they may not know. They're a consumer. They may not know that their rate needs to be locked. That there's an actual action that's called locking the rate. So don't think that the customers don't assume that the rate that they see on that application isn't the rate that they are going to get on the loan. That's 9 times out of 10. That's what they think, unless you've had that discussion with them. So we always want to have the discussion with the borrower and make sure that if they don't want to lock it in today or whenever it is, that they let us know. Okay, so I don't see any questions, so I'm going to give you guys a minute or two to formulate your questions. I know that we had a lot of information here, but remember, rate lock is not just about locking the rate, but it's about locking in the guidelines and the program, which is probably just as important, and in some cases even more important, because if a whole program is eliminated, then there's nothing you can do there. No rate adjustment that can happen at that point. You have to try to find a different investor and hope that the whole industry has it canceled out on that program. All right, I don't see any questions. I'm going to give it another minute because I know this is such an important topic that I want to make sure that we all get time to ask our questions. Yeah. All right. Well, I think then I must have done a great job, very detailed in my presentation here on the importance of having an effective rate lock management strategy. Please do reach out to your loan support specialist if you have any questions. Thank you and have a great day.